So I'm going to go ahead and call the meeting to order, combining all my words at once, at 8:35. And Lynn's going to, if she hasn't already started the recording, she will start the recording for the meeting. And I'm Heather Clayball. I'm the Associate Superintendent of Fiscal Services for Frederick County Public Schools. This is our first meeting of the new fiscal year, and we do have some new members to the committee. We're still missing 2 people, so hopefully they'll show up shortly. But what I'd like to do is just have everybody introduce themselves. And if you're a member of the FCPS staff, if you can just say what your position is and what department you're in. And then if you're the community member, if you just want, we have 2, but it looks like only 1 is currently here. If you can just introduce yourself and let us know why you wanted to join the committee, and then we'll get started with the regular meeting. So again, I'm Heather Clayball. I'm the Associate Superintendent of Fiscal Services. I've had this job now over 18 months. Feels like a lifetime. And what I'm going to do is I'm going to ask Lynn McKay, my executive assistant, who does not serve on the committee, but is our note taker and ensures our minutes are accurate. And to start with her introduction, please.
I'm Lynn McKay. I'm in the Fiscal Services Division. I've been here for 26 years. I am Heather Clayball's executive assistant and the recording secretary for the OPEB committee.
And then next I see Shirley.
I'm Shirley McDonald. I am a retired teacher, so that is why I am here, as well as a community member.
Thank you. And I see Derek.
Hi, I'm Derek Hoover Beat. I'm the program administrator for the grades 4 through 8 remote virtual program, and I represent FACASA, which is the Administrative and Supervisory Association.
And then I see Renee.
Hello, I'm Renee Milburn. I'm the Fiscal Compliance Officer, and I represent the, I guess it's now the NUG. And I have been here for about 4.5 years.
The NUG is the non-unit group. It used to be the administrative, oh my goodness, it's always AMT, administrative, managerial, and technical unit. We are predominantly the central office team is what sits within the NUG, and that's just a recent name change for us. And then next I see Megan.
Hi, and good morning. My name is Megan Quinn, and I am a personnel officer in human resources, and I am here representing human resources in the group. And this is, I think, my 3rd year, or maybe second or 3rd year on the committee. So thank you.
And then Justin.
We can't hear you, Justin.
Yeah, if you're speaking, I know Justin's on the call. I saw his name. Okay. So
Nope,
Justin,
we can't hear you.
we can't hear you. Justin is the representative for the Frederick County Teachers Association. He's the brand new president, just started on July 1st of the organization. And then we have our community member, and I apologize. I'm not going to say your name because I think that I will get it. I will not be well done. So I want to go ahead and get your name fresh in my head.
No worries, Heather. So my name is Hazune Mugwagwa. I'm the new community member on the board. I'm a parent of 2 Frederick County students in Urbana.
Excellent. Well, welcome. We're glad to have you here. And then I also see that we have some other staff members who've joined us, and I will go ahead and I'll just have them introduce themselves too. Sorry to put you on the spot this early morning, ladies. Melissa Rollison.
Good morning. My name is Melissa Rollison. I'm the Financial Reporting Manager here within Fiscal Services. And the OPEB is, we report on the OPEB each year. And so we just like to tune in and see what actions you guys might be taking and what reporting we might need to do.
And then Kimberly.
Good morning. I'm the Self-Insurance Fund Accountant and OPEB.
Thanks,
And
Kimberly.
I report to Melissa.
Excellent. And I think that's it, except for Christian, who is our advisor.
Thanks, Heather. Christian Severe with Siegel Marco Advisors. My colleague Tanya Keating and I are co-consultants to you as the committee for the OPEB. And we work out of our Washington, D.C. office. I'm actually, I live in Montgomery County, and Tanya lives in Anne Arundel County. So 2 fellow Marylanders.
Excellent. So, typically we would not go through the introductions, but since we had some new members and it's a new year, we wanted to take the time to do that. Hopefully you've all received your packets from Lynn with the minutes and the packet of that Siegel Marco produces for us. And then probably yesterday, typically we receive an up-to-date just breakdown of where we are as of the end of the month, closest month. So it was in August 31st. Chart with the current breakdown of the fund. And so we will start with the approval of the May 16th, 2025 minutes. Can I get a motion for that?
I motion to approve the minutes from the May 16th, 2025 meeting.
And is there a second?
I'll second.
So that was Renee. Oh, and Justin made it on.
Okay, good. It's working.
Uh, so all in favor, if you'll just raise your hand or say aye. Okay. Any dissent? Okay, looks like that passed by unanimous vote. So, but since we did get Justin on the screen, Justin, if you'd like to go ahead and introduce yourself, that would be great.
Yes, thank you. I am Justin Hyde. I am the newly elected president of the Frederick County Teachers Association. I started July 1. So this is my first time doing this committee. Missy Dirks has done it for the past couple of years, and I think we also had another member do it as well.
Excellent. Thank you, Justin. So I'm going to turn it over to Christian to run through our report.
Well, thank you. And again, good morning, everyone. Nice to meet those of you that we haven't had a chance to meet yet. We have a relatively brief agenda. The primary item is an update for the second quarter, which is the close of the OPEB's fiscal year. And as you'll see in a minute, very strong results to close the year. So some good news to share today. Feel free to slow me down or ask any questions along the way. I'm going to be pretty brief in terms of the markets and what's transpired there. It was a very eventful quarter, and then we'll focus on the numbers related to the plan. I'm going to share my screen if that's okay. And if someone could just let me know if that's showing up.
Yes, we can see it. Thanks, Christian.
Great. So just in terms of equity markets, you can see in the column here under QTD, that's the second quarter of the calendar year. Again, the fourth quarter of your fiscal year, about an 11% for US stocks represented by the S&P 500. What we haven't seen in really a long time up until this year is outperformance of non-US stocks relative to the US markets. And we did see that in the quarter. Here, this represents developed international stocks and then emerging market stocks here. If you look one column to the right at the year-to-date period, you see a bit more pronounced outperformance, close to 20% returns for developed international stocks, about 15% for emerging, and that compares to about 6% for the US. So for plans like yours that have diversified equity exposure globally, it's certainly been a good thing this year. If you look longer term, you can see that the US market is still pretty dramatically outperforming. These are annualized returns. And so if you look at the last 5 years, the S&P 500 has averaged close to a 17% return per year. And if you think about the historical average for the S&P, it's been something closer to 10%. So we have had, with the exception of calendar year 2022, really a stretch of pretty unbelievable equity market performance. I won't belabor this page too much other than to say, if you look at the within the US large cap portion of the market, and that's where stocks like ones you probably hear about in the press all the time, Apple, Microsoft, Google, some of the very largest technology oriented names in the US market, they really reside in this index, which is the Russell 1000 Growth Index. And so while we saw those stocks pull back, particularly early in April, you can see that at the end of the quarter, they ended up generally with about an 18% return. Just for those of you that aren't familiar, if you compare growth to value, value stocks are typically stocks that are a bit more beaten down in terms of their price relative to earnings expectations. There could be reasons why stocks are trading at a bit more of a discount, but the main differentiator here is really forward-looking growth expectations for these names. And you can see stocks with really high growth expectations, which tend to be focused in the technology and communication services sector, those really did outperform in the quarter. And then if you look out longer term, 3 years, a good example, where you've got about double the performance for those growth names relative to value. The good news for you in the portfolio is that you have exposure to all of these stocks, not just US and international, but also value and growth really across the US market. I'm going to jump ahead and just make a few comments about the fixed income market or bonds. For those of you that were able to join the education session that we recently did, you probably heard me drone on a bit about the yield curve, the treasury yield curve, and that's what this chart reflects. So the horizontal axis is the maturity of US Treasury bonds. The vertical axis here is what the yield is, which is essentially what you can expect in terms of return for holding those bonds. And I think the primary point I tried to make is that even though US Treasury bonds are perceived to be very safe, they do have mark-to-market changes. So they will move, the returns will change. And as bond yields come down, bond prices go up. And so if we look at what's happened here over the last 2 quarters, the yellow line is year-end 2024. And of course, as you move from left to right on the page, you see the yield go up. That is what we call a normally shaped curve, in that you expect additional compensation to hold bonds at a longer maturity. Now, what we saw is in this middle part of the curve, yields actually come down from the end of the year through the first quarter, which is the green line, and then again to the second quarter. As those bond yields came down, bond yield prices came up, and that was very good for the performance of the bonds that you have in your portfolio. Just one closing thought here, and then I'll pause to see if there are any questions. That the left side of the yield curve, this is really dictated by what the Federal Reserve is doing with its short-term interest rate, its benchmark rate. And so you don't see a whole lot of movement here quarter over quarter until the Fed actually cuts rates, which the market is expecting it to do later this month. Where you do see more divergence and where market really controls movement is in the intermediate part of the curve, which is the middle here, and longer dated bonds. So you don't see a ton of movement in longer dated bonds, but you will note that they've remained pretty high, whereas the middle part of the curve has fallen. Think of this yield curve, again, as the market reflecting short-term interest rate expectations over the long term. So these movements are really explained by things like expectations around growth, inflation, which we know is a very hot topic right now and is really going to drive where the market goes from here. So as you see a fall from short-term rates to intermediate, the market is sort of indicating that it expects the Fed to cut rates over the next few years, and longer-term rates are higher because there's a lot more uncertainty about where things will go from there, including where inflation is going to trend, once we sort of move beyond this year. One more chart just to point out before I pause on the market and take questions, if there are any, is just the Fed funds and other global central banks, what they've done with their interest rates. We know the Fed cut rates 3 times last year, brought down the Fed funds rate from a range of about 5.25% to 5.5% down to 4.25% to 4.5%. So that was a pretty big move in a short amount of time. But as you can see from the leveling off here, up to now, the Fed has not cut rates at all this year. And so this becomes a very big meeting in September, giving a lot of the pressure that the Fed is under from the president and other places. in terms of the economy softening and sort of counterbalancing that with its other side of its mandate, which is to control inflation. So there is some tension there in the Fed's mandate. As I mentioned, the expectation right now is that the Fed will make a quarter point cut in the rate later this month. Are there any comments or questions in terms of the markets generally? Hopefully that gives you a bit of backdrop in terms of what transpired in the second quarter. Okay. So hearing none, let's turn to the portfolio. And first, the executive summary. You can see here, nice uptick in assets, up from about 192 million at the end of the first quarter to 213 million at the end of the second quarter. That translates to investment gains of about 22 million, which, as I mentioned, you can see in the third bullet point, about a 7.5% return just for the quarter. 7.5% would be a good return in most calendar years. So that's a very high return for a very short period of time. It also outperformed the trust policy index of 7.2%. So good relative performance. There is passive or indexed investments for a lot of the equity that you have in this portfolio, but the international equity is actively managed, which means the manager is attempting to outperform the benchmark. And there was some outperformance this quarter, which is why overall the trust did outperform the policy benchmark. The asset allocation targets, as you'll see in a minute, are all comfortably in the range of the policy. So no concerns there from a rebalancing standpoint. And we do note that the latest investment, the Hamilton Lane Strategic Opportunities Fund 9, that is a private credit investment that was funded. The first capital call happened in the second quarter. So you'll see a market value there for the first time in terms of our quarterly reports. Any comments or questions here? Okay. So in terms of the asset allocation, I mentioned everything is comfortably within the ranges specified in the investment policy statement. Domestic equities or U.S. equities are close to half of the total portfolio. The policy target here is 47%. And then international equities are pretty dead on the target at 13%. So combined, you have a 60% target to U.S. equity and international equity. Fixed income, as I mentioned, is a large percentage of the portfolio and has performed very well. You can see an overweight here, 37% versus a target of 32%. And that's because the fixed income portfolio is the primary funding source for this new private credit investment. So Hamilton Lane is the manager. That first capital call was about $1 million, and that represents about 0.5% of the total assets. Over time, the objective is to get this allocation up to 7.5%. That is going to take a few years. We expect by 2030, with some additional commitments, that the private credit allocation will reach that 7.5% target. That, of course, is subject to the rest of the portfolio and market movements more generally. But this is a very different asset class than the others that you have. You cannot simply make a commitment today and get up to the 7.5% target. We want to make sure that you have diversification in terms of the different years that this manager is investing in. And so that's the reason why it's going to take a few years to get to that 7.5%. Just looking quickly at the numbers, and we tend to focus on returns. You can see those here at the bottom of the page. But just to translate those also into dollars, if you look at the fiscal year, which again just ended, close to a 12% return for the year. And that translates to about $22 million in investment gains on a starting portfolio of 191.7 million. So very nice return there. And if you look out for the 3-year period, over 13% annualized over that period, that's about $65 million in investment gains. Just to make a few manager comments here at the top, you've seen this, the total plan, 213 million in assets. Again, the fiscal year return of close to 12% and the 13.3 I just mentioned. You don't have to look too far down the page to see what's really driving those double-digit returns. It's the U.S. equity market and the international equity market, 15% over the last year for U.S., about 14% for your international fund. And there is a little bit of underperformance there with American Funds Euro Pacific, which actually just renamed itself. So we'll have that updated for the next quarterly report. It's now called the UPAC Fund. But the good news is for the quarter, that UPAC fund returned over 13%, which did outperform the benchmark. Out of curiosity, I looked this morning at year-to-date through August. This fund is up close to 20% now. So the good news that we had in the second quarter has only continued so far in the third quarter. The fixed income portfolio, where we've done a fair amount of work with you, there are some newer names in here. PIMCO Total Return is the newest that was funded. PGIM Total Return that was funded earlier this year has generated about a 4% return since it was funded in January. The other piece is a passive index. So it is a smaller part of the total portfolio, but it is intended to track this Bloomberg US Aggregate Index. It's about 10% of the total assets. That has returned about 6% since its funding, 6% for the fiscal year. And if you look collectively at this basket of fixed income, for the fiscal year, north of a 6% return, which was also above the aggregate. So it's been a very good stretch for bonds overall. I talked about yields earlier on the Treasury curve. If you look at the yield of this portfolio right now, it's at about 4.5% to 5%. So that's a pretty good predictor of what you can expect to get out of your bond portfolio over the next, call it 5 to 7 years. And obviously we're running a bit north of that right now. But again, even getting 4 to 5% out of bonds, that's a very big difference from where we were just a few years ago. So this is contributing nicely to the total returns as well. And then lastly, you have your cash position, which is modest, doesn't show up as any percentage of the portfolio. And the good news here with those high short-term rates that I showed you on the Treasury yield curve is you're actually getting a pretty good yield on cash. So about a 4.5% return over the last year for this small amount that you do have in cash today. Are there any questions? So just in terms of the near-term performance, I'll just give you one more page and then I'll pause. This is a fiscal year performance. It's a summary of what the plan has generated the last few fiscal years. And again, this year just ended, so 11.6 you see there. The prior fiscal year, a 15% return, and the year before that, a 13% return. I mentioned 2022, and just to highlight the turnaround we've had here. In that fiscal year, the trust was down 13.5%, and there was really nowhere to hide because you had both stocks down. You can see those numbers here, but also fixed income, which again is perceived by most to be pretty safe, and it should be pretty safe in most environments. It was certainly not that in 2022. So we've come a long way since that bottom, and just want to highlight for you that progression here as we just closed out this fiscal year. Unless there are any questions, I will just close my performance comments with the update that Heather mentioned, which is through the end of August, total assets, 220.5 million. So that's growth of about 7.5 million from where we were from the end of the second quarter, good for about a 3.5% additional return. So if you think about going back here to the calendar year, and you look at this 6.4, which again is the calendar year-to-date performance through June, and you add another 3.5% onto there, we're close to a 10% return on the OPEB for the calendar year so far. I'm going to end there, but happy to take any questions.
So I'm gonna start the questions, and then we'll if anybody else, if you want to raise your hand or just chime in, since it's a small group. So, jobs numbers are coming today. You said that the Fed meets probably later this month and is considering a reduction. In everything that I've been reading, as we are looking at our 27 fiscal year, we're starting that budget process here shortly. There are significant concerns about, is there a recession pending? State of Maryland in particular, this tri-state area is unfortunately in the red zone in regards to a recession. And then, there's just been volatility, right? It's every time we turn around, I don't know what's happening with tariffs and all of that kind of stuff. So, we have positioned our trust right to be diversified enough to withstand, typical market conditions. Do you have concerns given some of the, I would say volatility that we seem to be experiencing currently, that we're still in a good position in regards to that? You're muted. Sorry.
Thanks, Heather. Great question. Obviously, a lot going on in the world right now. I'll focus on two different aspects. First, I'll address some of the economic side of it, and then try to tie it to your portfolio and some of the asset allocation decisions that you've made. First, in terms of the jobs picture, we have seen revisions down. Last month, the prior 3 months through July were revised down to an average jobs growth of, call it 35,000 jobs added per month, which is dramatically less than, what we were seeing back in 2023 and through a portion of 2024. There was, of course, a lot to do over the quality of those numbers. The head of the Bureau of Labor Statistics was fired after that release by the president. I think there's some genuine concern now about pressure and, as with the Fed, sort of pressure on the independence of some of these institutions. I've only been able to peek at the jobs release this morning. It looks like about 25,000 jobs were added for the month of August, which is another very modest number. I think given that everything that has transpired this year, it is pretty reasonable to expect this slowdown in jobs to continue, at least for some period of time. That's for a number of reasons. Obviously, change in immigration policy, tariffs and the tremendous amount of uncertainty that has created. If you think about why markets are still doing as well as they are, a lot of it has to do with expectations for the Fed and what they're going to do in response to a slowdown, which we are seeing. And the other is because corporate earnings in the second quarter were much stronger than expected. We had double-digit earnings growth, again in the second quarter. There weren't a lot of people who really expected that. That was, powered in large part by the very large companies in the index that I mentioned that are spending tremendous amounts of money on artificial intelligence, really pumping money into the economy. Where that goes from here is also going to impact the market. So in terms of going back to the Fed and thinking about their mandate, they are responsible for sort of greasing the wheel in terms of the labor market and making sure things are, the economy is growing. They are very concerned about tariffs, and Jerome Powell in particular has been very clear about that. They want to be data dependent. The reason they haven't cut rates by 2 percentage points like the president wants them to is because their fear of doing that is that it's going to run inflation out of control. I think it's also fair to say we have not seen the full impact of inflation sort of flow through the system. There are a lot of very intelligent people who, with sort of balanced views, who think that even if we do see a spike in inflation, it could be somewhat temporary, just given other dynamics in the marketplace and the labor market, continuing to run much cooler than it had been. But this is sort of the spot that the Fed is in, where they're getting this external pressure. They want to see the impacts of inflation continue to show up in the data before they make, aggressive decisions around interest rates. And on the other hand, they are very aware that the labor market has slowed, that average hourly wages are slowing. And so I think at this point, because Chairman Powell has indicated that they're probably going to cut rates in September, or at least that's a very likely possibility, I think their focus in terms of the two sides of the mandate has sort of shifted to the jobs picture, and really some concern there that, a slowdown turns into something much more pernicious, and the unemployment rate really starts to take a spike, which we haven't seen yet. So that's sort of the muddled economic picture that I mentioned. Meanwhile, if you look at economic growth in the U.S., we had a pretty good second quarter number running in the 3% range, and that would be a pretty good long-term growth rate right now. I think though, in terms of inflation, the Fed still has this 2% mandate that they're trying to get to. And the reality is that we're stuck somewhere closer to 3%. We'll get the latest update in a few weeks, and that's right before the Fed's next meeting in the middle of the month. But, I think they've left open the door for that first rate cut, and that's what the market is looking forward to now. And I think the market is also looking forward to more rate cuts, beyond that first one. So you could have some policy that helps absorb more economic weakness. And again, going back to the market, I think that's why you have not seen more of a sell-off. But it wasn't that long ago in early April, when the tariffs were first announced in terms of their magnitude, and everyone was caught off guard by just how large they would be. We saw the S&P down 15% year to date, sort of down closer to 20% from peak. And now you look at where it is through August, and we've had about a 30% turnaround. So to your point about volatility, Heather, that has been very real. Right now, it has worked in the right way. And the hope, I think, again, is that the Fed helps sort of buffer the impact of some of this negative sentiment that's out there. Moving to the second part, in the portfolio and diversification, we've worked to try to bring down the overall equity exposure that the OPEB has. It's still about 60%. I think it was closer to 70, when we started working with you a couple of years ago. We've looked to new asset classes like private credit. And just as for those of you, I know a fair amount of you weren't around, private credit, the idea is to get returns that fall somewhere in between bonds and equity, but it is an illiquid asset class. And so one of the benefits is that it's not as susceptible to sort of the day-to-day volatility that you have in the markets. It's also a differentiated source of returns for the portfolio. So as we think about diversification, as we think about all the different things that could happen in the world, it's yet another asset class that we've been able to fold into the mix. And so the hope there is that it helps sort of even out, some of the downturns that we're going to see over time. I mentioned equities early in the fact that you are diversified not only by geography, in that you have U.S. and non-U.S. exposure, but also the types of stocks that are represented in the index. You have large cap exposure, you have mid cap exposure, you have small cap exposure. And then I think the last piece, which is really important, because it's about a third of the portfolio, is the bonds. And you have 3 mandates in there now. We've done some work to replace a manager that was previously in the lineup that was Western, that was a bit of a higher risk approach. Obviously, there were some other factors with the chief investment officer getting a Wells notice and really organizational concerns. But we've taken steps to sort of layer out the bond exposure you have to further diversify it. The index fund that's in there is an additional example of that, where you're really getting core bond exposure that's very high quality, very treasury and investment grade corporate focus. So I would say the diversification in your fixed income portfolio has improved quite a bit as well. That was very long-winded. Hopefully I addressed your questions, Heather, to the extent that they can be addressed.
No, I appreciate that, because without our being able to make deposits, and so right now it's just, for us, it's just the returns that we're getting. We did, for the committee, and Melissa will tell me if I'm wrong, we did receive the $1 million from the county, was invested into the, we got it, I think, in August. So we have received our one investment that we were planning to make this year, and that was a direct investment from the county. Nothing is flowing through our operating budget for fiscal year 26.
And my understanding, talking to the team, is that there was a second capital call for that Hamilton Lane Private Credit Fund, and I think at least some portion of that $1 million we intended to use for that capital call. So yes. You don't see those numbers in here in the second quarter, but you'll see them reflected in the third quarter report.
Yeah. Thank you. Does anyone else have any questions?
I just had a follow-up, if it's okay.
Absolutely.
Yeah, I think on the point I think that was highlighted on the volatility and the like. What's your view on, again, sort of one of the things we know, or at least in the market we've experienced with this, is that we probably expect a lot of a lot of people invested in the U.S. market, especially on equities, globally into U.S. markets. Um, do we have a view or consideration about, as we see, I know, I know a couple of global managers that are seeing that we're going to see quite a bit of the foreign investors starting to repatriate their assets back home as their countries start to, especially Europeans, start to look to invest back home, and also get concerned about the volatility we have for policy and the like, and how that affects us having been so heavily invested on the equity side and managing that. Is there any, I mean, I don't know yet what the view is on our balance to sort of, as the flows start to reverse a bit or even just stop coming into US assets, how we protect that and how that aligns with something that I didn't see in the presentation. Is we've got a good view on returns, but maybe sometime, but I didn't see any kind of commentary on kind of purchasing power preservation, that we're getting good nominal returns, but how does that relate to purchasing power, since retirees and to be retired would be kind of looking at those aspects?
Thanks for your questions. I guess first, in terms of the equity structure here, which again, the total target is about 60%. About a quarter of that is non-US, and that is unhedged. And I bring up unhedged because I want to talk about the dollar. I think what we would probably do, as a firm, we update our capital market assumptions on an annual basis. We typically do that towards the beginning of the new calendar year. So that would probably be February. So my expectation is that early next year, we will present an asset allocation review. And one of the things we want to look at there is sort of your mix of US to non-US. Obviously, that overweight that you've had, in this portfolio to US has served the trust very well in recent years, up until really this calendar year. And so we can run some different scenarios that just show the mix there. What I didn't mention when I highlighted the returns for the non-US piece in my market commentary is that, roughly half of the 20% return that we've seen in the developed international benchmark, half of that return, 10-ish%, has simply come from the US dollar depreciating relative to developed market currencies. That's the euro, the yen, some of the major, the Aussie dollar, some of the major currencies outside of the US. And so, thinking about diversification, that is another source where it's worked against us in years past as the dollar has done nothing but go up, but it is going the other way. And that is certainly helping international returns. In terms of flows across markets, what we've seen so far is not a dramatic flow out of the US market, not to the extent that you think when you talk about, the US dollar depreciating by 10% relative to a basket of other currencies. Part of the reason why, and you saw that in the second quarter returns, is these mega cap US stocks are still perceived by the world to be sort of the best that there are, the best position to take advantage of the artificial intelligence theme. Now we are seeing some other countries, and there's a lot of press early in the year about DeepSeek, and this is a Chinese firm, and their ability to sort of catch up to OpenAI and other large language models and do it with a lot less computing power. That all still has to play out. But I think the perception globally is still, even with a tremendous amount of fiscal uncertainty and policy uncertainty emanating from the US, that there are still these unbelievable companies that the US has that are just simply, better than what international markets have. That said, I think a lot of this is going to depend on where we go from here on policy and executive policy, which I'll be the first to admit is completely unpredictable. How how much does the U.S. ultimately sort of pull itself away from the rest of the world? How restrictive do they make cross-border currency flows, the ability to invest in other countries? These are all questions that are still really out there today. So I think the simplest answer, to the ultimate question of what do you do in this environment is you make sure you have the diversification abroad. You make sure that you have investments that can potentially take advantage of more depreciation in the dollar. And essentially you spread your chips, because we don't know so many things. We don't know what the impact of tariffs are going to have on other countries as well. I think we've been pleasantly surprised by how resilient these markets have been and how good returns have been. But that doesn't mean, just like in the US, it doesn't mean that at some point all of this activity that we've seen this year isn't going to have more knock-on effects in terms of some of these economies and some of these companies abroad as well. So and just going to your last part of your question in terms of purchasing power parity and thinking about the impacts of inflation elsewhere, it's very hard to believe that we are not going to see inflationary impacts elsewhere, in other countries as well. The one offsetting factor to all this potential inflation stimulus is the fact that if you have significant weakening in these economies, that's ultimately going to pull the consumer back, and that's going to tamper down the impact of inflation. So hard to predict right now a recession given everything, but a slowdown certainly in the US. Very hard to see longer term what some of the policies we've already lived through, but more importantly, where we're going to go from here and what's going to happen next. I know that's not a great answer to the crux of your question, but I think the ultimate point is when we think about how to invest in this environment, really diversification and having exposure to not just US, but international and non-US dollar is all very important.
Are there any other questions from the group? Okay, that is the end. That concludes our business for today in regards to the OPEB trust. Just as for those of you who are new to the group, currently we have no outflows from our OPEB trust. We still pay all of our retiree benefits costs out of our operating budget, and it's been because we have not been, as of last year's statement, our annual comprehensive financial report, we were about 28% funded for what our OPEB trust liability is. That has gone up this year. We're still finalizing the numbers. Our annual comprehensive financial report gets released on or about September 30th. So we don't have outflows, scheduled outflows for the trust to cover any expenses for our retirees. And frankly, we don't have them planned for the near future. We should be considering it based upon some of our modeling in the next decade. But as of right now, we're still able to maintain those expenses within the operating budget. So I think that's helpful in reviewing this, that although we haven't been able to fund the trust as the board approved policy has stated they would move towards, we have not had any outflows. So any market gains have really just stayed within the trust fund, and we haven't had, so it's been able to keep it pretty steady without the inflows. Ultimately our goal is to get to the point where we are making those, because there is going to come a time from an operating standpoint where we're going to have to look at a planned outflow to support the benefits as our retiree class continues to grow. But as of right now, that's not planned. And like I said, it'll probably be within the next decade that we'll start considering that. So if there are no additional questions, I want to thank everybody for their attendance today. Our next meeting is Friday, December the 5th. My goodness, it's hard to believe. And that is in person. So that will be here in the boardroom. So Friday, December 5th at 8:30 in person at the boardroom. So thank you all so much. For those of you who've just started your school years, thank you. I hope everything is going well. For those of you with children in the system, I hope they're having a great start to the school year. And good luck, and we'll see you in December. Thank you.